Investing in the stock market can seem like a daunting task. It's a world of its own with strange terms and confusing jargon. But don't worry, we're going to break down one of the most fundamental concepts: equity shares. In simple terms, an equity share represents a unit of ownership in a company. When you buy an equity share, you become a shareholder, a part owner of that business. It's like owning a tiny slice of a giant pizza, and the size of your slice depends on how many shares you own. These shares are traded on stock exchanges, bustling marketplaces where buyers and sellers come together to determine the price of a company's stock. The price of a share fluctuates based on supply and demand, reflecting the market's perception of the company's current and future performance. Owning equity shares is a way to participate in a company's growth and success. If the company performs well, its value increases, and your shares become more valuable. Conversely, if the company faces challenges, the share price may decline. Understanding this dynamic is crucial for any investor. Being an equity shareholder isn't just about potential profits, it also comes with certain rights and responsibilities. One of the most significant rights is the power to vote on important company matters. Shareholders typically have the right to vote on issues like electing the board of directors, approving mergers or acquisitions, and making changes to the company's bylaws. The weight of your vote is proportional to the number of shares you own, giving you a say in the direction of the company. Another important right is the entitlement to a share of the company's profits. Companies often distribute a portion of their earnings to shareholders in the form of dividends. The amount of dividend you receive depends on the company's dividend policy and the number of shares you hold. Shareholders also have the right to receive a company's annual report, which provides detailed information about its financial performance, management team, and future plans. This transparency allows shareholders to stay informed about their investment. In essence, owning equity shares grants you a voice in the company's direction and a stake in its financial performance. It's a powerful way to participate in the growth of businesses you believe in. Equity shares represent the permanent capital of a company. Unlike debt, which has a fixed maturity date, equity shares don't have an expiry date. Investors can hold on to their shares for as long as they like, potentially benefiting from long-term growth and dividend income. Dividends are payments made by a company to its shareholders, typically from its profits. However, it's important to note that dividends are not guaranteed. The company's board of directors decides whether to pay dividends and how much to pay, based on factors like profitability, cash flow, and future investment needs. The flexible nature of dividends is a double-edged sword. On the one hand, it allows companies to adjust their payout policies based on their financial situation. On the other hand, it creates uncertainty for investors who rely on dividends as a source of income. It's also worth noting that companies can choose to reinvest their profits back into the business instead of paying dividends. This can be a good thing for long-term growth, as it allows the company to fund expansion, research and development, or acquisitions. Equity shares are just one type of stock issued by companies. Another type is preference shares, which have characteristics of both equity and debt. Understanding the differences between the two is crucial for making informed investment decisions. Preference shares, as the name suggests, offer certain preferences to their holders. They typically have a fixed dividend rate, meaning that shareholders receive a predetermined dividend payment regardless of the company's profitability. This makes preference shares less risky than equity shares in terms of income. However, preference shareholders usually don't have voting rights and their dividend payments are not guaranteed. In the event of liquidation, preference shareholders are paid before equity shareholders, but after debt holders. The higher potential returns of equity shares come with higher risks. The value of equity shares can fluctuate significantly, and investors can lose money if the company performs poorly or the market declines. Preference shares, with their fixed dividends and preference in liquidation, offer more stability but lower potential returns. Ultimately, the choice between equity shares and preference shares depends on an investor's risk tolerance, income needs, and investment goals. By understanding the characteristics of each type of share, investors can make decisions that align with their overall investment strategy.